Welcome. My name is Goldie and I'm here with our team today, Georgie, Cindy, Alicia, Charlie, and Ash for our stock pitch of a long-term investment. We have explored two businesses, Premier Investments, founded in 1987, led by Chairman Solomon Liu and Deputy Chairman David M. Crean, who own and operate the brand collective The Just Group, which they acquired in 2008, and KMD, founded in 1987 in New Zealand, led by Chairman David Kirk and CEO and Managing Director Michael Daly, who acquired Ovos in 2018 and Ripple in 2019, expanding their product range and now operate on a global scale. Both of these companies have clear visions, with Premier Investments as inspiring to leverage its expertise and strong capital position to own and operate a selection of retail consumer products and wholesale businesses, and KMD aspiring to be the leading family of global outdoor brands designed by purpose, driven by innovation, and best for people and planet. Now I'll hand over to Georgie for the value drivers and red flags.
An important factor to account for when deciding what stock to invest in for long-term opportunity in a company is value drivers and red flags. Value drivers determine the critical factors which impact and indicate a business success, whereas red flags alert the investor about the company's stock's financial future. For Premier Investments, the three value drivers ranking from highest to lowest are strong capital position and established dividend-paying company, currently at 4.5%, and debt not at risk. Second is leadership, with Solomon Liu creating substantial intrinsic and extrinsic value for the company and shareholders. Finally, online sales and channels with continuous stable linear growth generated from the financial year 2019. The red flags are planning to demerge both Smiggle and Peter Alexander businesses, creating future revenue uncertainty from 2025. Cost of living causing less customer retention, resulting in less sales and profits. And finally, management concerns with an executive turnover, creating instability in management within the company. For KMD, their value drivers in rank are KMD's significant brand loyalty, resulting in higher cash flow from the sustainability and compliance development goals through KMD Village and Certified B Corporation, boosting their reputation by attracting socially and environmentally conscious customers. Secondly, expanded product range from their brand Rip Curl, and tourism in Australia increased with a large consumer of KMD. Their red flags preventing the business from achieving their goals are, firstly, decline in sales revenue by 14.5%, with climbing debt resulting in a higher risk to investors, as it suggests the company is financing a large amount of potential growth through borrowing. Second is the cost of living causing reduced customer purchase retention. And finally, climate change creating unpredictable weather conditions, causing fluctuations in customer sentiment over time as customers will purchase less jackets due to a growing warmer climate. I will now hand over to Cindy to discuss growth rates and probabilities.
In our analysis of KMD and PMB, consideration of various scenarios from different perspectives, including market dynamics and external influences, have resulted in the following three scenarios and associated growth rates and probabilities. KMD's best case growth rate at 7% with the input probability of 20%, base case at 5% with a probability of 50%, and worst case at -4% with a probability of 30%. Severe economic crisis and climate change are two of many factors that are resulting in KMD's declined sales revenues, which in short term outweigh the current green flags. It is estimated the high liability due to acquisitions like Rip Curl will begin to better current performances figures. Regarding PMB, for short term, a best case growth rate of 16% with a 15% probability hinges on leveraging strengths like strong capital, no debt risk, and established dividend payouts. Current economic crisis and high living costs affects discretionary spending. Furthermore, management turnover concerns suggested a higher base case probability. However, strategic leadership, including plans for a demerger, offers long-term potential. With online sales strength, the company could maintain a 9% growth rate at 60% probability despite current red flags. Finally, our estimated worst case scenario presents 5% growth rate with a 25% probability. To further delve into our chosen scenario, I will now pass over to Alicia.
A story of the base case scenario will be provided for each company. KMD will likely have a 5% growth rate as it expands its loyalty program to increase consumer spending by adding extra benefits such as a level reward system, free delivery, and access to outdoor apps. After COVID, tourism will likely continue to increase, further benefiting KMD sales to help pay off debt. The cost of living will likely stabilize in the future, which will help increase discretionary spending if tax cuts continue and inflation continues its downward trend, which will also decrease borrowing interest rates. KMD will aim to avoid its previous decline in sales by increasing its product diversity by expanding its Rip Curl products to increase sales during warmer months, which will help the company to positively grow. PMV will likely have a 9% growth rate as established online channels improve through incorporating new strategies such as loyalty programs. The cost of living will likely stabilize as previously mentioned, which will help the company grow from its already financially healthy position. Despite a shift in management as CEO Richard Murray steps down and John Bryce steps in as interim, a strong and experienced leadership team continues to exist even if new board members are added, which will create greater value and long-term success for the company. If Smiggle and Peter Alexander demerge, then PMV can still grow by attaining new and better acquisitions and by increasing its stocks in Myer and Breville to increase profit. Now over to Charlie.
Many calculations were performed in order to generate the numbers that are seen on the screen. Firstly, the growth and probability rates were discussed and decided on as a group. By doing this, we assessed the red and green flags, as well as the economic, managerial, and financial state of the brands. Secondly, the client rate of impatience / the uncertainty avoidance score was calculated on the University of Missouri quiz. We got a 26 out of 47 or a 0.55 for our tests. This is an average tolerance for risk. Next, the short-term growth rate was calculated by the addition of each growth rate multiplied with its probability. Next, the discount rate for uncertainty is an automatic function which is calculated through the multiplication of the risk inflation and the square root. Firstly, the risk inflation had to be calculated. This is done through the formula, as can be seen on the screen, of 1.1 plus, in brackets, 1 minus 0.55, or our uncertainty avoidance score, to the power of 3. Next, the square root is calculated. This was done using the square root function on Excel, which is SQRT, bracket, the probability times the short-term growth rate to the power of 2. Multiplied with the probability of each growth rate, and finally, the addition of each sum.
When evaluating investment opportunities for companies, it is crucial to compare the intrinsic value against the market prices. This comparison is essential because it helps investors assess whether a company's stock is overvalued, undervalued, or fairly valued in the market. If the intrinsic value exceeds the market price, the shares may be considered undervalued and could present a buying opportunity. Conversely, if the market price surpasses the intrinsic value, the stock may be overvalued and could potentially be a candidate for selling. Let's first consider PMV. Its intrinsic value stands at $57, whereas its market value is notably lower at $29.31. This results in a ratio of approximately 94.47%. Based on this, we can conclude that PMV is undervalued. Moving on to KMD, we find its intrinsic value at $3.83, while its market value is considerably lower at 45 cents. This yields a ratio around 751.11%. Therefore, KMD appears to be undervalued as well. It should be recognized that the intrinsic values for these companies were based on our inputted estimates, including growth rates and probabilities. Additionally, each company was identified to have value drivers and red flags that impact their overall performance. These should be taken into consideration when choosing an investment opportunity. Overall, upon comparison, both PMB and KMD emerge as undervalued, since their intrinsic values are higher than their market prices. However, KMD presents a more compelling buying opportunity because its ratio is significantly larger than PMB. If faced with the choice, we recommend investing in KMD as it appears to be more undervalued relative to its intrinsic worth, potentially offering greater returns in the long term.
Thank you for listening. The following slides are our references.